All right, good afternoon, everybody. Again, this is event trader Gavin McGuire, and we are being joined, of course, by Brett with Brett Manning, chart trader. Brett, how are you doing today?
I'm still doing good.
That is good. That is good. I just restarted for posterity's sake there. But as I was talking about in the intro, Brett, some of the things that we're looking at talking about today is, of course, some of the recent sentiment data, postulating a few theories about liquidity in the markets, and talking as well about your July 2nd piece on inflation. For reference sake, Brett, that piece you posted that was under your ETF daily notes, correct, from July 2nd?
That's correct.
Okay, so anybody that's going to want to follow along, that is going to be a centerpiece for what we're talking about here. That's really going to work into a lot of the commodity trades that we've been talking about, inflation in general. But Brett, I wanted to start off today's discussion talking about today's activity. Obviously, that sell-off that we saw in the markets was a little bit more aggressive than some of the action that we've been seeing, particularly on the sell side. We have bounced back and recovered about 60% of that move at this point. I was looking for a move back towards the 3150 level after we hit the 3100 area, but I'd be curious as to your take. Obviously, a lot of people are going to be pushing the narrative that it was the Trump tax headlines that caused this selling, and then the bounce back would have been around Pelosi and her stimulus package bill headlines. But I'm kind of curious as to your thoughts on what went on today.
Well, I mean, I don't buy into any of those theories. I don't think that the Trump tax stuff would have had any real impact. I mean, if you look at the betting odds, you look at the polls, I don't think that it would come as a shock to the market that there are setbacks for Trump in this campaign at this point. So I can't really imagine this being a huge deal. Plus, the way the Supreme Court handled it, it doesn't look like this is something that, is going to suddenly be released in the New York Times. I can't judge beyond that. That's just my gut feeling. Overall, I think that we've got a market, and you and I talked about this a little bit offline. We got a market where we've seen prices go up, and we've gotten into a zone where there's maybe some liquidity issues that allows the market to have more exaggerated responses to level breaks, technical breaks. We also have a market that is notoriously now in the hands on a greater percentage basis in terms of the tape makeup of traders maybe with less deep pockets than we've had in the past because there's more of a retail component involved. That can lead to a situation where you get tight patterns that suddenly and without warning turn into larger degree shakeouts if you get a level broken because there's momentum. There's people who've piled in on momentum strategies to the upside who then pile up the other direction with sell orders when the momentum goes the other way. So you can get sudden aspects like that, and you pointed to some data showing some shortfall in terms of liquidity and book depth in the E-mini futures for the indices as well, and that can kind of all contribute to that type of situation. So I wouldn't look at it as strictly a headline-driven phenomenon.
Right. And I think that's one of the big things that I was trying to press home throughout the course of the early session with regards to the liquidity. Now, you did postulate a couple of theories to me on why we might be seeing a little less liquidity in the E-mini futures. So basically one of the things that I've been looking at is the JPM note from Marko Kolanovic, in which he discusses the liquidity levels there. And one of the things that he was pointing out in this was that the E-mini volume is approximately, or the liquidity is approximately 60% below where we were seeing trading volume in the March correction. Now, you got a couple of theories around why that might be. Did you want to share that with us?
Yeah, I mean, there's a number of different angles to break down that data point. One would be in the middle of the March correction, the E-mini volume was probably the highest in history. So that's quite a point to compare to. Number two would be just before that, we had the release of the micro E-minis, which, especially when you start to see a higher and higher price in the market, are going to become more attractive as a trading vehicle to people. So when you just track the E-mini drop in volume and liquidity, you're not necessarily showing what might be, how that gap might be filled in by then saying, hey, lots of people who used to trade the E-minis suddenly have this new vehicle, the E-micros, which may be more palatable to them. So it's not just about new money coming in to trade the E-micros. It's about people transitioning from E-minis to E-micros. That's one of the other point I would make is that we have seen an increase in volume and liquidity in the major index ETFs, and the whole system, ETFs plus stocks plus futures, makes up really what's best viewed as a combined market. In other words, and one of the points in our discussion that I made is if somebody were to sell, let's say, $10 billion in E-mini S&Ps, and at the exact same moment buy $10 billion of the SPY ETF, the market, you may see a little quick stab of divergence between those instruments, but the computer bank in Chicago will quickly make up for that with strategies that are designed precisely around benefiting from that kind of divergence, and you'll see that snap back. The market really won't move at all if somebody does that. So it's really one gigantic market. Everything is one gigantic market when it comes to the indexes. So if you lose liquidity in something and you gain it in something else, you're really not losing liquidity overall. However, I think that the degree of liquidity that's being cited by JPM and Kolonovich is maybe enough that it suggests that we are losing some on a net basis. We're losing some liquidity in the market as we go higher. So there's probably some impact, but probably not as much as implied in the note.
Right. So the last time we saw a plunge in liquidity like this would have been in June of 2019. I'm curious to see your thoughts, because that would have been right before the micros were started trading. And the viewpoint at that time was that perhaps this was people moving out from using the E-minis as a hedging vehicle and moving more into the micro S&Ps for their hedging. Do you think that could be going on too, where people are just simply not using this as much of a hedging vehicle and therefore clearing out some of the liquidity?
It's possible. I mean, and also we've seen an enormous surge in options market activity over the last several months. If you just look at total option speculation, total option volume, the options market is having its heyday right now. So, I mean, some of it may be transferring, and that also, by the way, combines into this worldview of there's a single collective market, this big gigantic rolling ocean that is the U.S. equities market, and the E-mini S&Ps and Nasdaqs and Dows, they're just one part of that, but they all flow together. It's like trying to identify a current in the ocean and calling it a river that's separate somehow. It's really not. It can spill over easily into other vehicles that can make up the same basic force in the market. And that certainly includes options on SPY, or options on every single stock in the SPY. So we've seen options data go through the roof at the same time, and I think that's probably also another counterbalancing argument there.
Okay, well, we'll get into that options data here shortly, because we'll pop right into the sentiment side of things here and get into some of the robo ratios that we're seeing out there, the option speculation as well, and the small put buying. But let's start off, Brett. One of the nice things, since we've moved this to Thursday, we get a nice fresh look at the American Association of Individual Investors Bull Bear Survey. Now, we were talking a lot about this a couple of weeks ago, and we saw the bull bear drop down to that 22 area, or the bull side jumped down to the 22 area on July 2nd, and it fell actually as well from 48 to 45 on the bear side, everything popping up really into that neutral territory, which came in at 31.9. Taking a look at today's data and the differences that we're seeing, we saw the bulls move from 22 to 27.1. We saw a slight decline in the neutrals from 31.9 to 30.1, and then the bears declined from 45.8 to 42.6. So obviously we got a market on the rise, and one of the things that we've been raising a red flag on that wasn't making a lot of sense was this market on the rise, yet the bullish data remaining low is very similar to the October 2019 time frame when we were talking about that bubbling up potential for the markets. However, we did get a little bit of a spike this week. So how are you interpreting this AAII data?
So I'm mainly interested in the fact that it's so nicely dovetailing with what we're seeing, and we'll get into this in a little bit, but the B of A flow show stuff. I mean, it's basically the same kind of phenomenon exactly, that we've gone to a deeply bearish consensus. We've seen a large rally. It took a long time for people to move out of the mode of being deeply heels dug in, staunchly bearish, fighting this rally, hating this rally all the way up, to getting to the point where finally we're starting to see everything that's been acting that way just kind of peek around that corner and surface into sort of neutral territory for the first time. Again, options data is separate. Options data has been calamitous. It's been saying here comes a crash for a while. So if you just look at options data, you think this is a stock market bubble, you think this is late 1999, you think that we're in some crazy situation here that's doomed to end in some kind of crash. But a lot of the other data points, if you look at them, if you track it, people have been fighting this rally, they've been hating this rally, and all of that always kind of suggests the possibility that if the scenario turns out to not be quite as dire as people think, then all of them are going to flip and start buying everything. And so there's this kind of possibility of this, this sort of upward capitulation at some point. And a lot of things like the AAII, the B of A data, and there's a lot of individual data points that kind of all are tracking that sort of progression here. And for AAII and the B of A stuff, we've kind of moved from this extreme bullish sentiment data score to this sort of, initial stages of sort of neutral, where you can get more difficult shakeouts because there's not always going to be a chasing bid there because there's been so much under-owning kind of all the way up. So AAII is kind of now surfaced into that area too after turning into deeply bearish several weeks ago. Now we've got this kind of back into neutral sort of situation. So it suggests, if you trust it, if you want to extrapolate it out into a more conceptual way of looking at things, it suggests that a common way to pull the average market participant and understand where they're at with this market is the idea that they've hated this rally and they thought that it's ridiculous relative to economic data, relative to the risks involved, and then suddenly they're starting to see, hey, wait a minute, maybe it's not so crazy. And that's somewhere on the way toward getting improperly excited and leading to something that's got more sustainable downside possibilities.
Certainly. Let's keep with the sentiment theme, and then we'll move into some of the recent activity, of course, in China, which I know you've been paying attention to, and how that also works in with the Fed, and then that'll lead us nicely into your July 2nd piece that I think plays a prominent role in what we're looking at in the markets. But for the sentiment trader, Brett, you talked a lot about the breadth of activity in the options side of the market. However, when we're looking at some of the areas where we're seeing excessive pessimism pop in, one of the things that was jumping into me was the small put buying, but we're really not seeing anything like that on the put call ratio. You got any thoughts on that small put buying activity?
So here's what I'll say. If you want to single out either call buying or put buying as a single metric, so you exclude the other side, both are in extreme territories because there's just extreme participation in options right now. So small trader put buying is going to be at a historic level, but so is small trader call buying. There's just historic options trading. So it's skewing everything. It's really remarkable. This is a wholesale move into options are great right now. This is the options bubble.
Right, which certainly something that's been in play for some time now. A lot of talk about the retailers. We've been talking about it for months, about the retailers usually using
the leveraged derivative market. That's the one caveat here to everything in your universe when you're looking at the stock market. There's one way to explain why that would be happening, and that's because people who don't have enough money to buy shares are buying contracts.
Right. Now, one of the things that was most interesting about this was for the excessive optimism part of the sentiment trader, option speculation was coming in as well as the robo-PC. And that would basically go to your point, Brett. We're seeing record levels on both sides, but certainly the call activity's been far outpacing the put call activity for the last couple of weeks. So basically, how do you see that dynamic kind of come into play for the markets overall? Then obviously you got a lot more people. Do you think it's just simpler for somebody to buy a call option under the idea that, okay, this market's never going down, or do you think it's just from maybe a lack of understanding of how to use puts as a hedge against the downside, or they just simply don't think that there is a downside? How are you interpreting this activity?
Well, I mean, an options bet is inherently there's a stop. I mean, you one of the ways to look at an options bet is simply that all you can lose is the premium. You have a very defined risk, and if you want to turn a small amount of money into a large amount of money, one way to do that is, it's a lotto ticket kind of idea, is to buy a diverse portfolio of options positions, which are leveraged derivative instruments. So if you just have a very small amount of money, you can potentially double or triple it very quickly by being right about an options bet, and there's a defined level of risk. So I think that there's data that suggests that there's a component to this market that maybe sort of the shorthand would be, and I know Damon likes this too, the sort of the Robin Hood market. You've got a new set of market participants, and perhaps the retail component is starting to make up a larger than average percentage of the total transaction pie that defines the market on a historical basis by some, let's say, 5-6% over the historical average. And a lot of those traders may be undercapitalized traders who are finding ways to try and turn a small amount of money into a large amount of money over a short time frame. That is inherently, obviously, a characteristic of a marketplace that you should be suspicious of. But in the whole grand scheme of things, if you have the other 85% of the market that's been overly bearish at the same time and is maybe starting to kind of shift in that perspective, it's not necessarily damning. But I think that the options data, I think that the fact that it's been skewed toward calls, I think it really does simply suggest that options offer a low-cost way to a high-leverage return if you can get lucky, and that we have a disproportionate number of people in the market right now that maybe line up with that philosophy.
All right. So looking at some of the other sentiment data points that we saw out there, some of the items that suggested excessive pessimism, inverse ETFs. Do you think that maybe perhaps people are just using these inverse ETFs rather than puts as a hedge?
Hey, there's speculation there too. There's just speculation on both sides. I mean, this is and again, so this goes back to so if there was a theme that we covered a couple weeks ago in our last edition of this show, the theme was there is a dramatic widening, let's say, a widening of the reasonable outcome distribution for the market over any randomly picked historical moment. Right now, you're looking at perfectly reasonable people being able to harness data and make a reasonable argument for a deflationary depression or an inflationary bull market. And both are just as reasonable. So we've got this strange situation. The virus, let's say we can't find a vaccine. Let's say everybody gets it. We have to shut back down. We've got 2 years of slogging through a deflationary depression. We don't know. Maybe that's what's going to happen. Or let's say a vaccine's available in a couple months. Let's say the death rate keeps going down on a percentage basis. Let's say people just seem to start shrugging things off. Suddenly you have all this capacity coming back online. You've got all this pent-up demand. And you start to get this kind of, this let's say a chasing of the inventory to sales ratio. You get a boom, right? You have this massive amount of liquidity. Politicians aren't going to take that back in front of an election. So, I mean, you could really have this dramatic disparity in very reasonable explanations. So you've got this huge upside bet. You've got this huge downside bet. Both are reasonably well established by current data, and nobody really knows. So I think under those conditions, it's more likely that you're going to get more lotto ticket type speculation. And I think that it's reasonable to say you might have a huge amount of money going into call options on inverse ETFs and straight up proportional ETFs at the same time. And that just says there's going to be a big move somewhere, but nobody knows exactly where it's going to be. But there's going to be a lot of people out there trying to get rich off it.
Right. Okay, so there's one last headline or one last sentiment piece that I wanted to talk about, which would be the high-low. But before we get into that, I'd be curious as to your thoughts on, in terms of sentiment, where we currently stand with the coronavirus. I know that's something that you follow very closely. Of course, your family went through quite the incident with that. You were able to avoid contracting it somehow, despite three triplets, your wife and your aunt, all in the household getting it.
And let me say, our bet against circulating air systems has turned out to look pretty bright right now.
What do you mean your bet against circulating air systems?
So the first thing that we did is we turned off the circulating air system in the house and opened all the windows. And I don't know if you saw the 239 scientists that recently wrote a letter to the WHO, but the idea that it's airborne and look where it's blowing up, where the AC systems are most important right now: Arizona, Texas, Florida. Like, I think that.
Right.
Look, again, for a disclaimer for everybody listening, I am not a scientist or an epidemiologist, but
you play one on audio.
I play one on audio, and I've got 239 globally renowned scientists who are now lining up behind the idea that this is something that maybe can transmit through the AC system. So, yeah.
Again, a way to play that.
That was one of our key insights, was to turn off the central circulating air system within 10 minutes of knowing that my aunt had been tested positive, put fans in each room, and, open all the windows in the house.
Yes, and again, Carrier Global, CARR, was my play on that. That's been trending nicely. I think a lot of school systems and everybody else are going to have to go through and improve their filtration system, which, again, Carrier Global should be a big winner on that. But Brett, in terms of how the market is reacting and sentiment on COVID-19 right now, obviously we've seen that uptick in California and Texas, Florida, all the places that you mentioned, but not really seen a lot of reaction in the markets at all, no matter how much.
Interesting.
It is interesting, right? Do you think that's just we're kind of at a place where the market feels that the hospitals and the healthcare system is able to digest this influx of patients? Do you think it's because it just seems to be a younger generation that's getting it right now and therefore a little bit better prepared and perhaps bringing up our herd immunity? How do you view the way the market's been just taking this spike in numbers and really not batting an eye to it?
I don't know the answer to that. I just know that it's happening.
Yeah.
And it forms the crux of the trauma-induced inflation argument that I sent you in that ETF notes piece. The idea is, for some reason, this isn't shutting things down. This isn't causing a major change of behavior, and people are just moving forward. And seemingly, who knows why or how or whatever, it's just happening. But what if? So let's just get into it now, just really quickly. It's not a big discussion, but the idea is basically. So I take it from examining. If you look at oil companies, they form a type of game theoretic construction right now, and my argument is you can extrapolate it to the larger economy, and it has big implications if true. I don't have data to suggest it's true, but here's the conundrum. The conundrum is there's large fixed costs for oil companies to really expand their productive capacity right now. So they just went through large fixed costs to massively reduce their production capacity maybe a month and a half ago. And that was because they'd held on. They didn't want to spend that money to shut everything down. But then we had oil move from $40 a barrel to negative $40 a barrel. And everything was shut down. Now, as this data starts to pile up, when you're looking at positivity rates in Arizona of 34%, which means there's 10 times as many people with this in Arizona as being reported. You're looking at really terrible data from Florida, really terrible data from Texas, from California. That's a massive. Those are the three most populous states in the country. That's a massive proportion of the economy.
On that positivity front, Brett, do you just think it's? I guess it's a little bit of a disconnect for me because we never saw that in New York, right? The positivity rate get that
because they tested a lot. Arizona's not testing.
So you just think it's purely people that aren't feeling well going in, as opposed to New York just was testing anybody that was looking for a test?
I just think it was more available and easy to get tests with quick results. I
Okay.
know that it makes a difference if you can get quick results. If it takes a week to get results, you're much less likely to go get tested. I
Right.
felt that. I got tested 3 times. I know that if I knew that it was going to be a week before I got results, it would have been different. But when I knew that it could be 24 hours or less, then I was very quick to want to go ahead and get that test. So, yeah, I mean, I think that the positivity rate is a function to some extent of what we're seeing in terms of the rate of testing.
Okay. Um, so I know you follow the hospitalization rates pretty closely. Are you seeing an uptick in that has set off alarm bells in your
Say
head?
it again. Sorry.
The hospitalization rate, which obviously is a lagging indicator from the positive test rate, and then the death toll, obviously being the final lagging indicator. Have you been tracking these closely, and has there been anything that's jumped out to you on this front?
I mean, look, I assume that we have probably had this process going on that I called in another piece this kind of cultural immune system argument. I think that that's a reasonable inductive way of looking at things, that probably in areas where this gets severe and widely in cultural pockets where it gets severe. So I think every hospital in the country, I know my wife is on the board of a hospital chain, and I've actually been able to listen to some of their conference calls during this process, and hospitals immediately, as this started back in March, they started prepping for Armageddon. There was that process. So even if you see, I imagine even in Phoenix, Arizona, it's the same way. Hospital systems there, they're sitting there going, oh my God, I wish people were wearing more masks. What are we going to do? We need more ICU beds. It's like they've been thinking that for months. So my guess is there's an expansion in ICU capacity that's a trend that I haven't seen data behind, but it seems likely because I know that that's happened in hospitals that are in the network where my wife is on the board. Like they've taken steps along the way to prepare for the worst, and we're months in to the process of preparing for the worst. So my guess is we're starting to see some notion of the idea that there's been an increase in capacity to handle a worst case scenario. Even if it's not sufficient, who knows what we're going to see. I'm not downplaying the risk of that, but I think that there's been this isn't just a day after people felt like this was possible. This has been hospital administrators who are mostly really bright, well-educated people who are really sensitive to data and are really risk averse. They've been sitting in this situation for months now and have probably been very active in trying to prepare for worst case scenarios in a lot of places. Now there's a funding issue in some places, so that's part of the picture. But the vector that I would suggest, and again, I don't have this data. This is inductive reasoning purely, but I would imagine there's a robustness that's been building up under the surface to handle worse than hoped for kinds of scenarios around this virus in a lot of different facets of culture. So probably that's part of what we're seeing, is that there's some appreciation that there's been this kind of, what I call the sort of looming positive unknown unknowns have been maybe compounding a little bit along the way. We've got new treatments, we've got new supplies, we've got an increased capacity of personal protection equipment, et cetera, et cetera. So I know that it's not the type of thing that generally makes good shock headlines, but I imagine that kind of process has probably been trickling along underneath the surface and maybe accounts for some of the robustness that we're seeing. But when you look at, just go back to the positivity rate, it's a very simple idea. If 35% of people who are tested test positive, then it just absolutely means that about a tenth of the people who should be tested are being tested. Like, it's clear that a third of people are positive tests. It was 34% in Arizona yesterday. That tells you that the idea that cases really moved up by this tiny amount that's being reported is an absurd underestimation of how many cases actually appeared. So we're seeing that in Florida, we're seeing that in Arizona. Not so much in the other states, but those two states have these positivity rates that are really spiking, which suggests that it's actually significantly worse than the data is suggesting. So, I mean, I'm not sure that if that answers your question.
No, it does. It does. But and obviously it'll be something we'll continue to watch. I'm sure every time we go down, there'll be some narrative about the COVID impact here. But I think one of the things too that we don't see this much in the stock market, Brett, and it's going to break into our next area of this segment, is I feel like it's definitely been bifurcated in where this COVID's going to hit, and there's just really not a lot of downside left in some of these names in terms of the airlines. A little bit of a steadier hold there. The cruise lines, of course, the hospitality and leisure restaurants, where we've just kind of seen all the selling there, and people are quite content with sticking in the tech as the new work from home takes hold.
Sure.
So that brings us to into our transition here, Brett, from the last sentiment data point, which is one that we've talked a lot about over the last while, the high-low, which continues to show a lot of people piling in. And from that, I'm going to make a transition into the flow data from Bank of America, because there's a few things that were jumping out to me that I was curious on getting your thoughts on, and that's going to culminate once I read out these numbers into a quick discussion on the Nifty 50 and see if there's any parallels there. I'm kind of throwing this at you a little bit, Brett, so if you got any questions on the Nifty 50, I know you're well versed in it, but in terms of the overall action. But the S&P 500, the tech, healthcare, and Amazon and Google today make up 4,000 points of that S&P 500. It's actually been up 23.2% of this rally in the S&P 500. Everything
I
else
believe it.
Everything else would make up 2,900 in the S&P and has been down 10.4%. Just an absurd number when you take a look at it. And the concentration in the five largest stocks, in Microsoft, Apple, Amazon, Alphabet, and Facebook, now make up, I think it's 22% of the S&P. That's just absurd. We talk about top-heavy ETFs before in the past, and obviously this is.
What was the percent?
I got it at just under 23%.
All right.
That's the top five companies as a percentage of the S&P 500. Now, back in 2000, the last time we saw it reach a high like this was Microsoft, GE, Cisco, Intel, and Walmart. They hit about 18% of the S&P 500, and their percentage of the top obviously fell on a decline going over the next couple of years going into the financial crisis. But what I think the key thing is we saw a top-heavy move in this around 2001. Next couple of years were obviously difficult years. We had the internet bubble burst, and then after a quick recovery, we saw the great financial crisis. Now, obviously, a lot of people are looking back at the Nifty 50, Brent, a little bit more dispersed than that. This would have been where the 50 most popular large cap stocks.
50 sounds like great breadth.
It does, right? I mean, when you're considering it as a five.
You're talking about six.
Yeah, if you're looking at 50 now, you'd be like, we're fine. But
the sexy six versus the Nifty 50. Yeah, right.
Exactly. So this was a big theme in the 60s and 70s where people just continued to pile money into it. Now, eventually, we saw that stock market crash in 73 and 74. Now, there was obviously a few more factors in there, but I think one of the helpful factors in leading us in, there's the oil embargo and stuff like that. But you could easily argue there's a lot of factors going on right now too, right, Brett? So, it just kind of showed how it is in top-heavy action going in, and then we saw the 73, 74 crash following that crash of the Nifty 50. Curious as to your thoughts on the parallels here. How concerned are you with everything concentrated in these five? I think all five of them are above $1 trillion market cap too. I'm not 100% sure on that, but I can take a quick look while you're talking. But I'd be curious just to get your thoughts there, Brett.
Okay, so I think that a narrowing of breadth is obviously a vulnerability for the market. That's a well-established idea. However, but there's another angle on this whole situation that I can use as my sort of fun contrarian point of view here, which would be there's a new way to look at monopolies, that our FTC standards and antitrust laws really haven't been updated for a century and don't understand at all how to deal with. And it's not unreasonable to think especially with this coronavirus, this is eliminating small businesses everywhere, and watching their sort of, let's say, future cash flows are just going into these large companies right now, and some theoretical basis looking out the next 10 years because they're dying in the middle of this process. And large companies have the cash reserves to survive it, to find ways to fill in the gaps of those businesses being lost. So while there is a breadth issue, and I'm sure there's a speculative rush into the stocks that seem to be doing well during this process, it may also be to some extent the market pricing in or discounting the idea that there's going to be no updating of those antitrust laws, and that these 5-6 companies are going to start taking 20% of the economy in terms of market share. I mean, they're in terms of real economic activity, which would make this move perfectly rational.
It would. I do have a little bit more fear around the regulatory issues facing.
I have hope around it. I mean, this is not good for the long-term outcome in this economy.
Yeah.
If you can put a situation where 5 companies, 6 companies can game the situation and take over a 20 to 25% share of the economy. There's going to be a problem at some point that is ultimately founded or seeded by this process.
It is amazing, just in terms of when you're watching TV and stuff. I feel like half the advertisements I see now are Amazon. Like if you're looking at any job site, about 30% of the jobs on there are Amazon related and stuff. It's just amazing how much they're producing. But you got to think, especially since Bezos owns the Washington Post, that these regulators are going to want to chop down some of this power here. You've seen Apple with their with the iStore, people looking to rein in some of the power there, and Facebook obviously. Google probably not far behind. We've seen plenty of regulatory issues for Google in Europe, but if they go after these too aggressively at the wrong period of time, that could lead to a big outflow of money from the markets here, and just with how strong we are in those 5
Well, you got to take your medicine at some point. I mean, look, an empire with no competition eventually rots from the inside. There's no question about that. That's a well-documented historical narrative. That's why we have antitrust laws. That's why competition is seen as positive. Like, everybody intuitively knows this, but the structure in place right now doesn't account for the way that a company, if given enough market share and enough capital and enough really brilliant and talented people working all just for shareholders, will eventually take over, an empire with no competition. And we're watching.
Yeah, so again, this is, it's nothing new that we're introducing here, but I thought some of the numbers that we're seeing.
It's a big risk. It's a big risk for the Nasdaq. You're right. On a shorter time frame, eventually, there's already, if you look through researchers that are gaining ascendancy at the FTC at this point, there's already a lot of research that's been published that suggests that there needs to be a broad-based shift in the way antitrust laws are built and structured at this point to take account for the way that, there's been a dramatic change in the nature of doing business over the last 100 years. And again, those laws were set up around a world that worked very, very differently, and it obviously needs to be updated. And I'm assuming at some point it will be updated. And when it does, probably it's going to be a difficult day for the sexy 6.
Right. So
that could be years out, though.
Yeah, it could be. It's nothing imminent, but something that you always have to keep in mind. A couple of quick housekeeping items here. Scalp did take profits on half his position in that SPAQ, the SPAC that he was playing earlier. 12% gain there. That probably equates to a single for Scalp, right? These days, he's been hitting some pretty big winners there, but a nice play by him. The other item
spectacular. Yeah, right.
Yeah, the other item that I just wanted to point out was running into a little bit of resistance here at this 3150 area in the S&P. Again, that's the number that I had pegged that we'd likely bounce back to. If you're looking to lean on it, I think that this could be an area where you could get a couple of points here. So would look for it's come back in and check around that 3140 area, 3130 even for the S&P is what I'm looking for this afternoon. You got any thoughts on the S&P right here, Brett, before we jump back into the flow show?
No, I
Okay.
mean, not specifically in this area. I mean, I guess I'm just looking at a situation where there doesn't seem to be any signs of obvious risk aversion after this drop, which suggests, yeah, I mean, you could see exactly what you're talking about, resistance come into play. But
Yeah.
I mean, this trending situation has a habitual quality about it.
All right. So, wanted to talk about the rebound in the best quarters that we've seen in a while, Brett. And I'll run through. This is table one on that flow show, Brett. So you see the numbers that I'm looking at. Get your thoughts on that. And then I wanted to wrap it up with your inflation piece, which I think is very important, and some thoughts about the dollar as the Dixie hits a pretty key level in the charts. But taking a look at table one, and I ran through this with Scott yesterday, but Q220, we saw oil rebound 94%. We saw the S&P 500 rebound 20%. The MSCI World Index rallied 19%. The Nasdaq ran 31%. High yield was up 10%, and investment grade up 10%. Best quarters for these: oil, best quarter since Q3 of 1990. S&P 500, best quarter since Q4 of 98. For the MSCI World Index, best quarter since Q2 of 2009. The Nasdaq, its best quarter since Q4 of 99, obviously right around the internet bubble. High yield Q3 2009, and investment grade Q2 2009. So three of the components obviously rallied in 2009 post bubble, when we started seeing the Fed kind of jump into play here. Some very similar to the action we saw there. The Q4 98, Brett, for the S&P 500, that would have had to have been after the LTM scandal, right? From the
LTCM,
collapse,
yes,
the
absolutely.
LTCM. And then oil Q3 1990, I had that pegged as Kuwait, the invasion by
Yeah, which
Iraq.
is an outlier in all respects, before and after.
An outlier, and that's
It's a
why.
pointless data point. Yeah.
Yeah, so which probably factors into what I'm about to read next, which the general thought is, okay, we've come too far too fast. We got to pull back here, and that I think has been a pretty fair assessment from a lot of the bears. However, when we look at the following quarters after these results, oil, that was down 5%, but again, as Brett said, that was a little bit of a geopolitical one-time item out there.
Mm-hmm.
Of course, you could argue that COVID's a bit of a one-time item too, I suppose, but there's a little bit more in play there. The
Other
S&P,
direction, though.
right? The S&P 500 rallied 9%. The MSCI World Index the following quarter after Q209, another 6%. The Nasdaq, which I think is key because this was the internet bubble, so the others, you could look at it as crash and bounce backs, but this would rally another 9% in Q1 of 2000. And then the high yield and the IG rallied 6% and 3% respectively after those big moves. So with that in mind, Brett, how are you looking at Q3? I don't want to have you make a call too early until we get earnings season, but these numbers, does it have you a little less cautious perhaps on the bearish side?
Oh, I haven't been cautious at all. I mean, I own an investment portfolio long the market, and I've been basically saying that people were holding on to overly bearish views on the market on the way up during that quarter.
Right, and,
So,
and I didn't mean to imply that you've been bearish. I'm just saying in terms of the bearish argument, I guess would be a better way of saying it. Does this have you a little less cautious that we could see a continuation and not
right.
necessarily see that pullback? So I should have posted the question to you better.
No, that's fine. I think there's other data as well that shows that particularly large positive quarters, historically, generally speaking, aren't necessarily signs that you're in a situation where the next quarter has to revert to the mean. Momentum is unquestionably, historically, cemented in as a fact of the situation for stocks, and especially after, I would say, if you look at this situation in context, and this will come up in our next discussion as well, that you have this really large, dramatic, and traumatic downside catalyst and reaction. And in my experience, when you get something that stretches the rubber band that far the other way, you don't just snap back to the middle. You snap back to stretching the rubber band the other way. And there's a lot of different forces that are involved in that process. And I think that when you get this snapback rally, you have, I think, an increased likelihood of then overly exacerbating the opposite, equal and opposite reaction, which would be, the kind of, as we talked about earlier in this, the idea of a sort of capitulatory upward sort of crash in the market that can come from people having been, let's say, too willing to accept the possibility that things are going to be quote unquote okay, and then suddenly need to reposition. And you've got people short, you've got people holding puts, you've got people in inverse ETFs, and you've got money managers who are underweight, and all of it kind of flows together into the same moment of everybody realizing at the same time in the opposite scramble. And maybe after that, then you get a reversion to the mean. But maybe we haven't really seen that at this point.
All right. So, Brett, wanted to end the discussion. Again, anybody that's looking, Brett posts his daily ETF notes. And back on July 2nd, he put forward a theory, and we've been talking a lot about it in this, just with the amount of fiscal and monetary policy that's being put into play here. But the title of your ETF daily note was Trauma-Driven Inflation, based around oil, but also something that could factor in to some of the other areas. Both of us have been hammering the gold long here. That continues to rise. Looks pretty much like it should continue to run unabated. But do you want to just kind of throw out what you were postulating in this discussion, Brett, and what people need to be taking a look for and keeping an eye out on moving forward?
Yeah, sure. So, the basic idea, it's not, that landmark theory, but I think that it's an inductive kind of logical, game theoretic sort of supposition. I don't have data to support it necessarily, but my sense is the data we have so far certainly doesn't contradict it. And the idea would be that if you look at the oil market as a separate and individual situation, then maybe we can extrapolate from there. But the idea is that oil producers shut down a lot of their capacity in response to rising demand, and at the same time a worsening of virus statistics at this point. What we've seen so far is that they've been reluctant to really bring a lot of that capacity back online because they're braced for the potential that we could go through once again what we went through in March and April. And that almost killed a lot of oil companies. And so they're probably reluctant, but you have to pay to shut them down. You have to pay to open them back up. You have to pay to close down production capacity. You have to pay to bring production capacity back online. So there's a double whammy to this process, and it would be a bet on the idea that there's this stability to the sort of pent-up demand that's coming online. And I think that there's a not unreasonable possibility that we might see a kind of a situation where a lot of large oil producers get caught way behind the curve in terms of bringing capacity back online, precisely because of the trauma that they experienced in March and April and early May. And bringing it back online would be a risk, and they don't want to take that risk until they have a lot of confidence in a steady replacement of demand. And the fact that there's not going to be a fresh wave of shutdowns. And we certainly see lots of virus data that suggests that, it suggests that there's the possibility of that kind of thing, and it's easy for a committee of people to be unwilling to go ahead and sign off on this new fixed cost investment. So I think that you see a situation that's ripe with the possibility that we could see a supply shortage simply because people aren't willing to take the risk to bring the extra supply back online while the virus data looks as bad as it does, even though there's this continued growth in demand. And that, to me, suggests the possibility we could see a spike in the price of oil coming out of this area as we move back above 41, 42. We get a lot of traders who are short, looking for that kind of, here comes the news of Florida and California and Texas starting to announce new shutdowns or whatever. That's an obvious kind of bet. And if that doesn't happen, and if oil producers continue to not bring capacity back online, and refiners get drawn all the way down in terms of products like gasoline and distillates, and then the refiners have to turn and they start to draw down Cushing, and yet still the oil producers won't be willing to make that fixed cost investment, we could have a real supply shortage. We could have, 42 to 65 be the kind of move we see in oil. So we could have an outsized spike to the upside, just as we saw an outsized spike to the downside when things were shutting down. So it's kind of this equal and opposite reaction kind of idea again. And there's, I think, a conceptual, game theoretic, landscape-driven idea that's at the heart of that. And to me, some of my best trades have been when they're centered around that kind of idea. If you have trades that are driven by just here's a bunch of publicly available data, the data says this, you analyze the quantifiable data and you translate it into a trading thesis, I think you're going to be dealing with an efficiency problem in a lot of ways. If you have an idea that's drawn from something more conceptual, from a logical argument that's more inductive, where you've had to insert a kind of leap of faith premise yourself, it's much more likely that you're going to catch the market off guard if you're right. So I've generally found that broad idea to be productive, and this would fit with that. But that got me thinking, does this same phenomenon define a lot of different things? So let's say you produce something that's sold in stores. You think the demand is going to be cut short. You maybe don't produce enough. Stores don't pile up enough inventory, right? Or other commodity producers outside of the oil markets may be in the same situation. They don't want to make a fixed cost investment if they could be caught in a situation where the economy starts to shut back down. Policymakers could be in the same situation as well. They put a lot of stimulus out. They want to keep putting stimulus out. And they don't want to be in a situation where they've understimulated the economy, in a situation where the virus data is getting worse and worse and we have to shut back down. So everybody's kind of caught in this same conundrum. There's a trauma that happened a few months ago. There's a lot of data showing that you can't be sure that trauma is not going to repeat itself. But what if it doesn't? And we keep seeing gradual increases in demand. We keep seeing there's plenty of stimulus out there. The whole thing adds up to me to be this basic, broad, if you really just 30,000 feet, it's just too much money chasing, by definition, too few goods. There's too little production of things because of the lack of willingness to do this fixed cost investment in re-expanding inventories, in re-expanding production, in re-expanding everything, because you're worried about hitting that trauma again. And yet there's just tons of liquidity out there. People have the money. And if we keep seeing these gradual increases in demand, the Citi Economic Surprise Index has hit all-time highs in terms of the bullish surprise versus what economists are forecasting. That's another example of the same kind of phenomenon. People are assuming a worst-case outcome, or at least kind of bracing for it. But what's happening day after day is we keep getting expansion in demand. If you keep getting those two things correlated together with plenty of money out there, I don't see how you don't see at some point a dramatic upside number in terms of inflation data.
Yeah.
But that, at the same time, just let me put a caveat into that. That's not necessarily something I think that's going to lead to, let's say, a crash in 30-year bond futures, because really this is all about a vaccine. So I can temper that whole argument back by saying this is solved by a vaccine, because then you've got this confidence in the idea that you're not going to see a new shutdown. So there's a time window where we can see some really outsized inflation data come seemingly out of the blue. We can see a commodity price spike in lots of different places come seemingly out of the blue, but it's not necessarily something that impacts the very long-term idea of what's going to happen around inflation, because it's really driven by this strange set of circumstances.
Right. I think one of the things helping drive that over the last 2 weeks, Brett, was China and basically them giving the all clear earlier in the week with the Securities Journal coming out and saying that they thought it was a great time to buy stocks, which would be tantamount to the Fed basically saying that they see stocks as cheap too, and certainly helps provide a boost. Copper prices have been marching higher too. That's definitely been helped out by some of those surprise indexes that that you were just mentioning. That Citi Surprise Index that you sent over, I hadn't taken a look at it in a while. But it was breathtaking to see. I mean, it's like exponentially above any other highs we've seen over the last
People are
20 years.
underestimating the demand snapback that's happening. Yes.
Now, I would assume a lot of that had to have been that jobs number that came in. Certainly the PMI figures, which are softer data and going up against comparisons, worked their way into it. But again, one of the things that I've been thinking is one of the bigger risks to the market is if we start seeing that flat line. And I feel like we've hit the low-hanging fruit, and perhaps maybe we see a whip back on the other side. Do you think possibly where economists start throwing out numbers a little bit higher just so that they don't get caught off guard?
Naturally.
And then we start seeing an underperformance in this indicator, and we see
It's
an
a
aggressive
recursive system.
snapback.
Yes.
Yeah. So that's going to be one of the interesting things that we're going to have to keep an eye out for. So, Brett, anything else that you wanted to add to this trauma inflation?
No, I think that it's an interesting. You can see the sort of small, simple version of it in the oil market, I believe, and that's why I still believe that we're going to see a breakout to the upside. I could be completely wrong about this, but it's the type of analysis that has led to some of my most important successes in the past. Just seeing a kind of something that makes strong common sense to me in terms of the various actors on a sort of game theory stage that adds up, and that eventually the data is going to come to reflect that. And that would be eventually the data coming to reflect large drawdowns in terms of crude oil inventories that don't have any immediate response. And that puts the market in a difficult situation. And lots of people probably positioned, given the virus data, for a downside move in oil. And both of those things add up to me to be, again, a kind of an answer, a mirror opposite to what we saw when we went to negative $40 a barrel. And I don't think we've seen that yet. But I think the interesting thing is to suggest that that's a situation that's built of a game theoretic conundrum that applies to a lot of things other than oil as well. And what are the implications of that?
All right. So just heads up, the market has reversed back down, hitting that 3140 area. I talked about, I think 3130 certainly will come into play here. Then that should lead to an interesting overnight, because we've certainly seen markets rally when China's open, because
man,
that's just
crazy,
never-ending push higher there. So I would expect 3130 to hold. Perhaps we see an overnight bounce back to 3150, but I do see a little bit, and I talked about this earlier, the potential for some profit taking ahead of next week's earnings kickoff with all the banks and everything. I wouldn't be surprised to see a little bit of cautious activity going on over the next day or two. Brett, we're going on about an hour, so I was going to end the discussion here, unless you had anything else that you wanted to add, and we could do a quick recap. So, basically, as Brett and I were talking about, we're certainly keeping a close eye on the liquidity that's out there. Some concerns about the E-mini liquidity, but other instruments certainly seem to be moving with a lot of volume behind it. But as Brett had noted, the use of options and certainly has given this a leveraged feel among retailers, and therefore we could be prone to these pockets. And I think that's going to be one of the key things, not to let the shake you out too much from your longer term positions, but having an understanding that there could be a little bit more volatility there, and taking that into consideration when you're playing risk, and trying to use the lows for buying opportunities and to fade at the highs potentially over the next few sessions. That could certainly be working its way into play here. Brett, is there anything that you'd like to add on this recap that you thought was pertinent in this discussion?
No.
All right. Now, Brett and I will be back on tomorrow, as well as Damon and Scott and Jim and Craig, as we do our trader strategy meeting. Very timely opportunity for us to do that as we get prepared for the Q3 earnings season. I think that will certainly be the next catalyst, as people are going to be looking at the linearity comments, seeing how things have progressed in June and July, particularly with a lot of areas starting to shut down. So I think that's going to play in here And that's certainly going to be a key topic for us tomorrow. We'll probably circle back around to some of the comments that Brett had made, some of the theories that he put out there as we discuss the overall macro economy and get deeper into the weeds. Just about to hit that 3130 here area here now, Brett. So hopefully some of you are able to jump in and get short. Obviously, I was talking with Brett, so didn't really have an opportunity to jump in and post that trade. But if you did jump in there, I'd be banking a bunch of it for the 20 points. And you could probably leave your stops in at the entry, which should have been in the 31.48 to 52 area at the time we were talking, and just see if you get a move overnight. But Brett, as per usual, always a pleasure talking to you. Always fun hearing what you have to say. Your insights always welcome by the subs. So definitely good to hear what you have going on in your mind right now. And for anybody looking for the replay of this, I will be posting it tomorrow morning. As a heads up, we've got a few things to take care of here. So tomorrow morning will be the repost for this if anybody's looking for that. But Brett, you have a great night. We'll talk to you tomorrow, and that's going to be at noon Eastern time for the Trader Strategy meeting.
Perfect. Thanks, Gavin. Nice call.
All right. Talk to you soon.
Take care.